Only through God's grace. Today I help 2,000 plus high net worth clients and manage over $120 million. And in this video, for the first time ever, I will actually share with you exactly what these wealthiest people of our community are investing in, what their portfolios look like, and the truth will really surprise you. These figures are from actual investors, including at least a couple of billionaires, several folks with net worth in the 8 or 9 figures, but the bulk of these investors will typically have net worths ranging somewhere between 100k to 3 million pounds, the affluent person next door. So these investment strategies, whilst they are being used by people who are super wealthy, are actually much more accessible than many of us might initially think, and we definitely can learn from them. For those of you new to the channel, I'm Ibrahim, and since 2016 I've helped millions of Muslims with their personal finances and investing, and I run an investment firm called Curate Capital. I've written a best-selling book and hold qualifications in Islamic law, investment management, and corporate law. Before we get into exactly what our investors' portfolios look like, let me first cover off what the average portfolio looks like and why exactly this typical portfolio is not ideal at all times. Let's begin. In a study, Vanguard shared the average portfolio of the typical investor on their platform. The average asset-weighted portfolio consists of 65% equities, 22% fixed income, and 13% cash. So let's see how this performs. Here we've assumed 100k investment and we've put 65% into stocks and 35% into fixed income. I've assumed that fixed income is going to give you 7%, which is a tad optimistic because in reality cash will either be making you nothing or making you about 4%, but let's roll with it and just see what happens. So over a 10-year period, you'll end up making 7.66% per annum and roughly double your money. Your portfolio risk rating, admittedly this is not a super scientific methodology, but still it's a very helpful rule of thumb, is around 6. This is not a terrible result by any means, but it's also not amazing either. Let's unpack the issues. The first and obvious issue with investing in only 2 asset classes is that you're not particularly diversified. Sure, typically stocks and bonds, or sukuk, will move in the opposite direction, but actually in certain times, like we've recently had as well by the way, they can and do actually move in the same direction. And that means that your backup plan of diversification basically failed and your entire portfolio tanked. And when inflation is high and you have volatility in the market, that is exactly what happens. So spreading your risk across multiple asset classes is generally a good idea. The second and less intuitive point is that you're actually restricting your potential portfolio returns by restricting yourself to just those asset classes and not building in more aggressive asset classes. But to make that point, we need to explain a little bit about modern portfolio theory. And this is a theory that ended up winning its creator the Nobel Prize. Okay, here you have a 4x4 grid. It doesn't take a genius to work out that you want to end up in quadrant 1, higher returns and low risk and volatility. Now let's layer in what a stocks and bonds portfolio would look like on this quadrant. So what ends up happening for most folks is that they will have a mixture of stocks and bonds and aim to get into quadrant 1. But what happens when you diversify asset classes, particularly into those asset classes that are uncorrelated, i.e. their prices are generally not really going to go up or down at the same time as the thing that makes the prices go up or down for stocks and bonds? When you do that, you end up pushing that entire line upwards. So you can end up with, as you can see on the graph, a higher return with the same or even sometimes lower overall risk. Let's just show that mathematically again with the same £100,000. Well, isn't that interesting? With the same risk profile, you now end up making 11.2% per annum and roughly 3 timesing your money over 10 years. And by the way, if you want to access this spreadsheet and twiddle around with it for your own purposes and model out your own stuff, then I'll include a link below that you can get it from and you can download it there. Okay, so all of this sets us up really nicely for what the average Curate Capital investor's portfolio looks like. Now, I'm going to caveat this with this is an overall portfolio of all of our investors. So the individual investors may very well have very different looking portfolios to the one you're going to see, according to their personal tastes and their investment goals and their time of life. But a good many of these people will have a portfolio that looks very similar to the one that you are going to see. So ladies and gentlemen, this is what $120 million roughly looks like. As you can quickly see, our core funds are what make up the majority of the investments. Our income fund, our real estate fund, our EIS venture capital fund, our pharmacy strategy, our Curate cash savings account offering. There's a lot going on here, as you can see, but broken down into a more simpler graphic, we have this. So you can see that the breakdown is around 27.7% venture capital, about 20% real estate, 10% private equity, and 40% is in fixed income. And remember, we actually started as 100% allocation to venture capital because that's what we only did back in the day. So the reason why venture capital is actually so high here is because all of the rest of our investment classes have actually been scaling up and catching up over time. And if we adjust the timelines to just show what has been happening this year with our investors and where they've been putting their money in, it will give you a nice sense of this, because now you can see that fixed income is 50% and everything else is near enough around the 16% mark. Interesting stuff, isn't it? And by the way, this is just our GBP investments. US dollar looks something like this. US dollar is a little bit skewed because we've not done that many deals in US dollar, and a number of the deals that we have done have been venture capital focused. But even so, you can see that our investors are pretty clued on, because you see the overall approach to investment has been pretty measured. They made much larger allocations to safer investment classes, but with a healthy dose of venture capital in there as well. And note, the VC investments have mostly been across funds as opposed to individual startups themselves, which significantly decreases the risk, because then your one investment into a fund is spread across at least 30 different startups. Okay, so the first and really obvious lesson here is the degree of diversification that is taking place across our entire portfolio. Our investors have had the luxury of picking and choosing across multiple high quality investments, across multiple asset classes, and they have steadily built up a very well spread portfolio over the years. The second observation is that our investors have looked to play it safe most of the time, using our fixed income funds, our property funds to do exactly that. That's the kind of backbone of their portfolio, which gives them a decent amount of liquidity, i.e. they can get in and out of these investments relatively easily. It's lower risk, and that's what draws these investors in. And thirdly, I suspect most of our investors have actually got about 20 to 30% of their portfolio in stocks and shares, which isn't being captured on this particular pie chart because we don't currently offer anything in the public markets and stocks and shares world. But that would only add even further diversification to the picture that you're seeing at the moment. Fourthly, investors have made sure that alongside the venture capital, they are actually investing quite heavily in private equity as well, because private equity typically offers similar-ish returns, not as much returns, but pretty similar to venture capital, and it doesn't necessarily benefit from the tax benefits that venture capital comes with in the UK, but it does come with a lower risk profile overall. So investors have been quite interested in this category of investments. Fifth, investors have actually diversified across multiple currencies. We know our USD investors invest very regularly in our GBP deals as well, and our GBP investors definitely invest in our USD deals as well. Sixth, using this diversified portfolio approach, you actually end up with a projected return over 10 years of around 12% per annum, with a lower risk rating, interestingly enough, of 5.5. Now, isn't that very illuminating? I do stress again that this is just the model with some key assumptions that you can adjust, and that can actually move the percentages up or down by 1 to 3% even. But the point should be an obvious one. Rich people invest intelligently and they get better returns as a result of that. We make a lot of videos on this channel talking about the theory of investing and why you should or shouldn't invest in XYZ thing. But the whole point of this video is to show our subscribers, you guys, that there are real people out there that are investing real money, their money, and significant amounts of it, and they are doing it intelligently, and their bank accounts are benefiting from it. So hopefully this has inspired some of you to start your investment journey, whether that's with Curate or anyone else, or to adjust your ongoing portfolio if you've already started your journey and you've picked up a few tips from this video. If you'd like to learn more about how you can take your first investing steps to becoming a millionaire with just £250 a month, watch this video next. Until next time, Assalamu alaikum.